Kyle and Samantha Bush just lost $8.5 million. And they're an elite household. They have a whole team of people working for them, right? They have tax strategists, CPAs, financial advisors.
That's what actually stood out most to me, right? The fact that they have all of those people. They have their own accountants, their own strategists, their own advisors, and yet they still got scammed by the whole IULs, right? So people go and talk about have all the upside and none of the downside.
Or like you said, they should be with someone who's a licensed investment professional because they're an investment.
They are. That's what they are. They're operating like an investment with limited upside because of those participation rates, because of those cap rates. So in my opinion, it's not even a good investment. You don't get all the upside. But hey, to each their own. If you want to use IULs for investment-like properties or in strategies and try to get a death benefit, just make sure you're working with someone who's in securities. If you're trying to build banking policies, work with a bank builder, work with an IBC practitioner.
Welcome to another episode of WealthWise Banking. We had this guy actually sneak in. If you can't see, you know that I'm standing right next to the one and only Jeremy Lee Huggins is here. So welcome, Jeremy. How you doing today, brother?
It's good to be back down here in Florida with you, man. Spending time with you, your family. I'm excited. We got a great dinner planned tonight.
Oh, I'm looking forward to dinner too, my brother. So just imagine this, right? We saw the news this morning. So imagine waking up to learn that the safe plan that you were sold just lost $8.5 million. That happened to the two-time NASCAR champion and his wife, Kyle and Samantha Bush. And imagine if them with $80 million in net worth, with a team of financial advisors can get burned. What about everyone else? So this episode is that wake-up call. IUL is not infinite banking. We're going to show you together plainly how IULs quietly drain wealth and why properly engineered whole life is the foundation for a true family bank. Your policy should be a vault, not a stock substitute. So we want to keep the volatility outside the policy in real investments that you know, like, and understand, and keep the certainty, the guarantees, and dependability in the policy. And by the way, this is not legal advice, not investment advice. Use a qualified pro for those things. So, Jeremy, what are we going to talk about today?
You kind of hit on a couple things, right? We're going to talk about how infinite banking and IULs are not one and the same. Why is it that these people are still selling IULs that are out there? And if you have an IUL, what are your options? And that's what we're going to talk about at the end. So stay tuned. If you do have an IUL and you're wondering, well, what next? I don't want to lose any money, let alone $8.5 million. We'll discuss that at the end of this podcast.
Amazing. And we're going to go over some different highlights over history. And we're going to talk about how IULs just really haven't been around long enough for you to know what really is happening, right? What's going to be the long-term effect of the decisions that were made, whether they are recently, 10 years ago, 20 years ago, 30 years ago, 40 years ago, right? When these things were just born. These things are just babies.
Yeah, they only came out in the 80s. So they're 80s babies.
They're 80s babies. Oh, man, that was a wild. No wonder. Drugs and big hair and IULs. I never even put that together before. But imagine having what happened to the Bushes, Jeremy, where is an $8.5 million wake-up call, right? They put $10.4 million into something that they thought was safe and guaranteed, and they're an elite household. They have a whole team of people working for them, right? They have tax strategists, CPAs, financial advisors.
That's what actually stood out most to me, right? The fact that they have all of those people. They have their own accountants, their own strategists, their own advisors, and yet they still got scammed by the whole IULs, right? So people go and talk about have all the upside and none of the downside. And we need to talk about that and expose like the lies that are associated with IUL, especially people who are trying to use IULs for infinite banking.
And when you're talking about, when you read the article, when you go and do your research on this, because by the way, don't believe what we're telling you. Go do your own thinking. We really want everyone that's listening to us to do your own thinking. And this is with the Pacific Life. I mean, they're a huge mutual company. Huge, right? And they're what we've heard, we were listening to this earlier. We heard Samantha, the wife, talk about is, listen, every time that they have an obstacle, they believe that God's put that there for them to turn it into something good, to turn it into an opportunity. And then they're saying that this isn't just the elite that are getting scammed. It is the teachers. It is the regular everyday
The
people, the
veterans, yeah,
veterans, everybody. And we've talked to
firefighters, everyone.
firefighters and police officers. We've talked to a ton of people who have been in the same situation. So maybe it's not 8.5 million, but it might be everything they have that they put into this, believing that it was going to operate a certain way. And they saw the math, the illustrations look great, and the reality,
Hmm.
not so great.
Not so great because they what they illustrate is far from reality. And I think that's what people need to understand. If when you introduce cap rates and participation rates and high fees, right? The high fee structures that are associated with these things, the continual rising cost of insurance every single year, these policies collapse. And going back into it, they're 80s, they're from the 80s. If you were on the leading edge of these policies in the 80s and you got one, they're just now starting to come full life cycle, right? 45 years, you got it in the 80s, right?
Mhm.
45, probably got it around 20, 30 years old when you did it. There's not enough time, there's not enough data, not enough statistics to support these. So they're just now starting to reveal the deception.
And with the deception, I think even a stronger, like thinking about the way that we've been talking about this in our conversations before, launching into this, was just how many variables there are within the design and I mean, the illustration alone is typically 50 to 70 plus pages when it comes to an IUL.
Way many more pages than a whole life
Way
policy.
many more. I like that.
Yeah.
There's some good English. Way many more. We got like 3x the number of pages just to explain all of the different things that are going on. Even if you're financially savvy, even if you understand the market, you're not transferring the risk to someone else is how I always think about this. You're once again, like most other things, like investments, you're assuming the risk.
Hmm.
You're assuming the risk. And, when you're looking at this, and by the way, how many times, I mean, you were telling me this earlier, how many times have regulatory changes been made during this period of time? Like,
Oh, they're constantly changing the regulations on IULs, right? And you got to think about that. If they're changing the rules and they're changing the reason for the rules, is it really going to be trusted? Again, it's from the 80s and they consistently change it over time. So they do have, I forget the regulations, but it's like AG something, AG 49 and other patches they put in place to try and absorb some of these shocks. But the insurance carriers specifically selling IULs like Pacific Life, they're finding ways to add layers of complexity and introduce indices and tying it back to markets, which in turn does what? Exposes volatility, exposes more risk into your system. Again, these are banking systems. This is a process, not necessarily a product. And we use the product for banking, which means that you should separate your investments from your guarantees.
1,000,000%. And if we kind of look at what the illusion is, right? You always hear things as you have the upside without the downside, right? You
Mm-hmm.
have the what do they call it? You have you're protected.
Oh, you're talking about the floors and the
The
ceilings?
floors and the ceilings,
Yeah.
yes. I got confused for a second because we use floors and ceilings when we're talking about the manageable floor and the meaningful ceiling, right? But we're talking about something different.
Yeah. So they talk about the participation rates and the cap rates, which they allude to. You're going to get all the upside of writing this index, but there's a participation rate. So as an example, let's say that you have an 8% participation rate and that the market ended up growing by 15%. Well, you're not going to get the full 15%. You're going to get 80 or 8% of that, right? 80% of it. And that's going to put you
Yeah,
at
you're talking about
12.
the
Yeah.
you're talking about the ceiling and the contribution rate, which are
Right.
two of the variables that you do not control. Who controls those, Jeremy?
The carrier does, Pacific Life in this instance. Yeah.
Get out of here. That doesn't sound right. I thought it was our contract.
It's their contract for the IULs.
And I'm just playing, but this is what the Bushes believe. They believe that they had a safe tax-free growth strategy, but instead they rented an index formula. They tied their money to a market that's volatile.
Hmm.
And that's what we're seeing. That's what's happening with them coming out and making sure that others are aware of this. And so what was pitched as a self-funding policy, it turned into a money pit. It turned into a nightmare.
It did. And it was, thank goodness they got out of it because it actually would get worse over time. They're a young family. And the older you get, there's a rising cost of insurance every year. It's continuously increasing. It's what is it called? Continuously renewing term insurance.
Yeah, 1 year renewable term.
Yeah, every single year. So think about that. What is the term policy on an 80-year-old?
And that's what, and I wonder this too, because when I talk to folks who have gone down this rabbit hole, and this won't sound kind, so I apologize early, and Jeremy doesn't even know what's going to come out of my mouth next, but I call it the dummy tax. Like when we make a mistake in life, like there's a cost bias to things we do where we just don't want to say, oh, that shirt I bought's really ugly. Even though everyone's told you, your wife's told you, your friends have told you, like, dude, that looks terrible. And you keep wearing it because you're just like, you're like, well, I like the shirt. I bought it. It costs a lot of money. It's this brand. It's got to look good.
Mm-hmm.
It's the same with an IUL. Like all of a sudden, you believe you saw the illustrations. They look like this glorious. It's just going to put my money in, and it's going to grow at this 7-8% year over year, and I'm guaranteed all this money later, and it's going to protect my family. And you think it's doing all these wonderful things, and then all of a sudden, you're like, what? It doesn't work like that. It's not what I thought it was, and so you pay the. If you get off that train early, you pay a dummy tax and you learn your lesson. A lot of people, they keep going.
Mm-hmm.
They keep plowing forward. So thank God the Bushes were like, you know what? 8.5 million. I mean, for 80 million we have, that's a lot of money, but it doesn't break them.
Yeah. Well, interestingly, I had a call this morning with the regional VP of one of the insurance carriers we love working with and talked to him about this specific case. And when I called him, I was like, hey, have you seen what's going on with the Bush family? And he's like, yeah, I did actually. This reminds me of when I came on board. I inherited. So early in his career, he inherited a bunch of these universal life and index universal life policies. And for a lot of the folks that were getting older, well, interest rates ended up changing. The cost of insurance went up. And what people were, older folks who were paying typically $50 a month for their premiums, were now paying $300 a month. So it went up 600%. So here they are at a time in their life, their golden years, when the death benefit, I know we talk about banking a lot, but when that death benefit matters most, they had to surrender the policies. I mean, think about that. You spent decades paying into this, and now it rose by 300, 600%. It's like, come on now.
And that almost like what I just thought of, and that sounds like the uninterrupted compound interest that we see in what we help people with, which is a specially engineered whole life policy from a mutually owned carrier that supports infinite banking, right? We're going to talk a little bit more about that. But when you look at like my son's policy, you get out to like when he's my age and he's got a 600% return on the capital that's going into the policy.
Positive returns.
Positive. That's what I'm saying. It's the opposite. It's like the opposite. It's like that compounding because you're getting older, you're getting closer to death. It's a 1 year renewable term. The cost inside of an IUL continues to rise, and it starts eating at the cash value, the other variables that are there, the upside, right? The ceiling, the contribution rates, there's all these things that make this a really, really dangerous combination for people who are thinking about using this for banking.
Yeah, working with someone who sells IULs, to me, and I think of it akin to real estate, right? I work a lot in real estate and investing. It's like working with a landlord who can change the rent whenever he wants. That's what it's like. When you're with IUL, they can change those rates at any time that they want, and they advertise it as protections. But in the cases of when I was speaking with the regional VP, he said it actually destroyed all of these people's policies.
Yeah, and they're surrendering them when they need them the most. They're surrendering them when we need the most. And think of a 600% increase. So whatever you're paying premium deposits into whatever thing you have right now, think about that being 600 times more expensive down the road.
Mm-hmm.
And you don't have any control over that. And what you learned today, and I love that you were sharing this with everyone here this quickly, is that with the Bushes, right, the reality is it underperformed compared to what they were told, the pitch. And that they're left holding the bag. And when you were talking to, this executive for one of these giant mutuals that we do work with, and we work with them a lot, he said it was some of the toughest times and conversations he's ever had.
Yeah, it's a terrible conversation to say, hey, that insurance policy, I know that you were told that the cost of insurance would be level, that it would stay the same, but due to rising interest rates, due to all these environmental factors outside of our control, we're going to have to go and increase your annual premiums by 600%.
Imagine this. Like I always like to talk about banking as an act that, like Nelson said, of imagination, reason, logic, and prophecy. So we're going to use our imagination for a second, folks. As long as you're not driving, I want you to close your eyes. And I want you to imagine yourself today calling yourself 20 years from now and having that conversation that this executive had to have with everyone who had to surrender their policies or pay 600% more.
Mm-hmm.
How would your future self getting that phone call from you today feel when you're like, hey, Bobby, you know how you got this because you thought you were protecting your family and you thought that this was going to be the thing that, you're thinking long term. You think you're doing the right thing. You think you're protecting your family. You think you're locking in these guaranteed growth rates. You think that you're getting the upside of the market and you're protected from the downside when the market doesn't do well, right? With the floor. And now you're calling yourself and you be like, Bobby, remember when you sat down 20 years ago and you made this decision to put your money into an IUL for banking and you were hoping that it was going to give all these things that were illustrated? Well, it didn't. And now it costs more.
Mm.
Like, just think of what that conversation I'm calling your future self up and having that would feel like.
So why is it, Jason, that these life producers and these insurance agents out there, why are they selling these sort of policies? You kind of alluded to it earlier.
Well, I mean, why are they doing it? I want to believe in the best in them, Jeremy. So I'm not going to tell you what I really think, that they're greedy motherfucker. I'm going to tell them. I didn't say that, right? I didn't say they're greedy. What I'm really going to say is they just don't know any better. They really don't understand the product that they're selling. They don't understand the complexity of it, and they don't even know the purpose of why you're doing it. I was on the phone conversation with someone the other day, and he's like, "Yeah, I have an IUL, and I'm putting $100 a month in it because my friend sold it to me because when I told him I didn't have any savings and I was saving $100 a month, he said, well, that's enough. Let's just start there."
Mm.
And I was like, "Oh, that's a really good friend. You guys still close?" So the reason they're doing it is because they are going to win every single time. They're making high commissions on these things. That's what Jeremy was asking me to say. And the insurance company is always going to win because they control the contract.
They control the participation. They control the growth. The way that the insurance carrier looks at it is, well, we're investing the money into the stock market and this Vegas casino over here. So we're going to limit the amount of upside that you can actually get, and we're going to take the rest.
Yeah, we are the house. We're playing with house money. We know we're going to win. And they're incentivizing these agents who, again, I'm going to say they don't know, but there's 100,000 plus agents out there selling this. And I felt really horrible for the Bush family. And at the same time, when I saw that this morning, I was a little excited that someone that has a little bit of, that has a platform like they do, that is amazing people like they seem to be, is going out there and taking this on, is taking this on for everyone else, right? Is because now they're going to shine a light on this.
Yeah. And it's good. It's definitely good to, it's terrible for them, but through their pain and suffering, they're able to educate many more people. And I hope that you are right for those agents that are out there who are selling IULs. They're ignorant. But then that's what I'd get back to you. If you're working with someone who's ignorant, is that really the person you want to be working with?
No. In general, you want someone who's going to solve your problems. And you said this earlier, and I just want to bring this up again because I find this really interesting. There's a guy out there. You guys check him out. His name is Bobby Samuelson. He has different, like, he speaks and he works with all these different carriers, and he just really knows this industry forward and backwards. And he talks about all the regulations that are coming every couple of years, changing how IULs are illustrated.
Mm-hmm.
Because they're going to, like, 10 years ago, they're showing them, hey, they're going to be at 8% growth.
They assume the stock market never drops.
Well, what they actually do is they're putting a bunch of super brainiacs, a bunch of Pinky in the Brains in the room, and they're looking to take over the world, and they're making up an index that doesn't exist, and they go back 10 years. That's how they're actually created. Did you know that? I think we've talked about it before.
Yeah.
but they're actually not created from an actual thing. They're like, what would look good today? And let's forecast it back 10 years. And that's how they're creating the illustrations. And that's why they don't perform.
And past performance is not indicative of future results.
And exactly. And they're so and this is why they keep being regulated. Like you alluded to, or you didn't allude to, you talked about AG 49. Like, why didn't this fix it? Why do we keep needing AG 49, AG 49A, and on and on and on? Because it's really showing how unstable the designs are because they're over promising and over delivering.
Over promising and under delivering.
Did I say over delivering?
Yeah.
Wow. Thank God you're here. Thank you here next to me, to kind of point that out. And then why do we do what we do? Like you were talking to me earlier, like Jason, Jason, when you break your arm or you break your leg, you don't go to the dentist,
Yeah.
right? That's what you were talking about. You don't
Yeah.
go to the dentist to try to get that repair. That'd be a mess. Like, oh, let me get the drill out. Like, what do we do instead?
You work with a financial professional who actually is educated and trained in that asset class. So if you want to go out and do investments, go work with someone who works in securities. If you're trying to build a banking system, work with bank builders. Work with IBC practitioners like Jason, like myself. There's a group of us. We had to go through a rigorous certified training program, right? And I can tell you right now, IULs not in the program, not even a little bit. You'll actually get kicked out.
Yeah, we actually signed documents that said we will not use an IUL or any UL actually, any kind of UL for banking. And so why is whole life the foundation then? That's kind of what we're talking about right now. Why is it the foundation? Why do we like it instead?
Well, whole life for starters, been around for over 200 years. It's not an 80s baby. So we have centuries of data.
So it's not a hairband.
Yeah, no.
No, it's not. It's not Poison or Motley Crue or Trickster
It's
or any
not
of those.
it's
No.
not a coked up rock star. No, it's not. It's a stable asset class that has been around before the IRS that has guarantees. You know exactly what your annual premiums are going to be. There's a guaranteed column, and the carriers that we work with have been giving a dividend every single year for over 100 years, right? So those we're not talking about hypotheticals. These are actual guarantees that are built into the system. You do what you say you're going to do. That's a contractual agreement between you, the policy owner, and them, the insurance carrier. And that private contract, so long as you do what you say you're going to do, the insurance carrier does what they do.
Ooh, that was important. As long as you do what you say you're going to do, which is you are going to do what? You are going to pay yourself first. You're going to move where you're keeping your savings and put it into your specially engineered whole life policy.
Mm-hmm.
And you said another really good word. I think it started with a G and ended with a E. Like,
oh, guarantee?
yeah, guarantee. I like that word too. Who doesn't like guarantees, right? In this crazy, crazy world we live in, wouldn't you feel better having some more guarantees? And when we talk about whole life, we're talking about three guarantees right from the get-go, right? You have a guaranteed contractual interest rate that the policy is going to grow.
Mm-hmm.
Every single day it gets better. Every single day it's better than a day it was before. Because why? It's contractually guaranteed to grow, and it's growing tax-free away from Uncle Sam. So guarantee number one, guaranteed growth, contractual. Guarantee number two is guaranteed level premiums.
Mm-hmm. Not the changing cost of insurance.
Nope, not a 1 year renewable term that's getting more and more expensive the older you get. Because why? You're going to die someday.
Yep.
Guaranteed level premium. But guess what? We design these things so if something does happen in the future, you do have a manageable floor that you can actually go down and make sure this thing stays alive. Do what you need to do.
If anything, your premiums go down. They'll never go up, but we can scale it down based on emergencies, life happening, that sort of thing.
Based on how you see yourself being 10,
Yeah.
20, 30 years from now, depending on what you're wanting to do, right? And then the third guarantee, so we got two guarantees. The third guarantee is what? It is the guaranteed death benefit, the guaranteed legacy piece.
The tax-free legacy piece, mind you.
Oh man, I forgot about that part.
Don't forget that one, taxes.
Phew. If Jeremy wasn't here next to me, I'd be a mess today. I'm saying crazy stuff. I don't know things. But so Jeremy, for folks that are listening, because there's a lot of you out there that do,
Mm-hmm.
if you own an IUL, what are you supposed to do?
All right, so this is the big thing. If you own an IUL, the very first thing that I would do is I'd call up that insurance carrier and I'd ask for an in in-force illustration, INFORCE, an in-force illustration. Compare it to what it is today versus when it was first illustrated. And let's just start there. Let's start with the in-force illustration. Then go ahead and, because you've already tied it to an index, you've already tied it, tried to make it an investment, right? Look at the minimums and the maximums in terms of your cap rates and participation rates and determine, all right, am I good with the minimums? You might have to overfund it for a little bit, right? Get back into some self-funding. If you don't want to do it, you just want to rip the Band-Aid off, get the dummy tax, as Jason said, you can do what's called a 1035 exchange, which is changing the cash value into something more stable, like an actual, I don't know, banking policy, an infinite banking policy, one that has the guarantees that we talked about. And I've done that with people, right? I've helped them transition something that was volatile into something that was stable, so that way they could actually go out and invest from a position of strength, not volatility.
You can tell he's getting more and more passionate about this, and like his energy's growing. He's getting taller standing next to me, and so But the one thing that Jeremy and I will never tell you to do is 1035 something. What we're going to say is, what are you trying to accomplish? What is your goal? What is the goal today? Where do you want to be in a decade from now? Where do you want to be in 5 decades from now? And then we start building that plan together. So sometimes, yes, we will help someone 1035 it if it makes sense.
If it makes sense, because sometimes those fees don't make sense. Let's be quite honest.
Yeah, the surrender fees, if you're within the first 10 years, sometimes I have multiple people that just hold on to the policies and put the minimum in until they get past the surrender charge.
Yeah.
But again, it's, you want to pay the dummy tax, get off the train, however you want to look at it. You have to decide what that timing is for you. So don't feel bad. We're not trying to make anyone feel bad, because a lot of folks out there, you have IULs. If you have it for a retirement plan, or maybe you just have it for, an additional thing for later for protection, it can work that way. Like, that's not a bad thing to have. But if you're trying to do it for banking, that's when we need to have a conversation.
Yeah, I would look at it more for the legacy piece on what that death benefit is and hold that in place. For the banking, again, if you're going to build banking policies, work with a bank builder, work with an IBC trained practitioner, right? If you want your investments, go out and do investing. I invest with my IBC policies all the time, but I keep the guarantees in the guarantees. I keep my money in the vault. Yeah. I keep my investments where they're supposed to be, outside of my policy.
And what you're saying is, you're making a spread by putting your money that's in the policy, the cash value, to work, while it's still growing, uninterrupted, compounding, and guaranteed. Right? So now you've given that same dollar 2 jobs. And this is what the banks are doing. This is why it's called become your own banker. Like, we hate on the banks all the time. I say bad things about them being the evil empire, but they are the #1 purchaser of this stuff.
They are.
And
we got an episode on that too.
Yeah. And they're making a lot of money on our money. So why don't we just do what they're doing? That's what Jeremy's talking about. We did the same thing. We got rid of the interest rates we were paying the banks. We brought it back into the policies. Now we put it out into something that we're comfortable with, that we feel like we know, like, and understand. We have passive income coming in. We're making a spread in the policy. And so Jeremy was talking about, you don't go to the dentist for a broken arm. So that's why we talked about this once already, but you want to find somebody who is, if it's not us, just make sure they're a certified infinite banking practitioner from the Nash Institute.
I'll even go one step further. If you are going to go work with someone who's selling IULs, make sure they have a securities license. Make sure that they understand actually what investments are and what true risk is, because you don't want to be working with an amateur. I mean, to Jason's point, hopefully the people selling IULs are just ignorant. So if you're going to go the IUL route, work with an IUL professional who actually has a securities license.
Here's a shocking fact that just came to my brain momentarily, or a second ago, was if the Bushes put $10.4 million into IULs, that means that agent's commissions were 10.4 million plus.
Yeah.
Just so you guys know, just think about that for a second. So that's someone who has a high, in my mind, a high level of responsibility.
Should have a fiduciary responsibility.
In that. So like, that is where they have a leg to stand on if it doesn't perform that way. And I'm curious to see where this goes for them. And I really look forward to the updates that they're going to provide. But for all of you, we're trying to get this out there again to protect you, to give you the education so you think for yourself. this policy is your vault. Like what we're telling you to do, it's your vault. It's not the Vegas table.
Hmm.
It's not like let's go put it all in red. Do you
Yeah.
gamble, by the way?
I don't even drink.
I know. I didn't, and then you brought me a bottle of mead, and it's so good. I have to. But no, I don't even bet on my favorite teams. And anyhow, I'll leave the next thought to everyone's imagination. So, in this case that we've been talking about, it's a real life warning. It really shows how the IULs are, like you said, they should be with someone who's a licensed investment professional
Hmm.
because they're an investment.
They are. That's what they are. They're operating like an investment with limited upside because of those participation rates, because of those cap rates. So, in my opinion, it's not even a good investment. You don't get all the upside. But hey, to each their own. If you want to use IULs for investment like properties or in strategies and try to get a death benefit, just make sure you're working with someone who's in securities. If you're trying to build banking policies, work with a bank builder, work with an IBC practitioner.
And that's it. I mean, that's it. And if you're ready to build a system that actually works for you, this is when you want to book a strategy call at wealthwisebanking.com. So it's wealthwisebanking.com. You can book a call with Jeremy or myself. Again, both certified IBC pros. And we're going to meet you where you're at. We're going to have the conversation. If you have IULs, get those in force illustrations and email them to us because we'll take a look at them. We'll tell you what you have. We'll talk about why you're trying to do it and make sure it makes sense.
Yeah. And if you want to learn a little bit more about how IULs could destroy your banking strategy, go visit episode 14, right? We did the podcast on this on episode 14, and it was titled Why an IUL Can Destroy Your Infinite Banking Strategy.
And keep digging deeper, keep thinking for yourself, do your own research. There's a ton of information out there. Look at what the Bushes did and what they've lost and what they're standing for. Losing $8.5 million is horrible. But if you're losing $8,500 or $85,000, like it has
It's all
it's
relative.
all exactly, that's my point. So
Yeah.
if this isn't performing the way that you thought it was going to, let them be that beacon for you not to make that same mistake.
Mhm.
Any other thoughts, closing thoughts as we're wrapping this up?
No, we saw this literally this morning. It came out this morning. The court case was published on the 28th of October. Today, as our recording is the 29th of October. We're publishing this kind of almost as an emergency podcast just because of how impactful this was. When I read it, I was like, holy smokes, Jason, we got to talk about this today.
Yeah, this wasn't even the podcast that we had slated for the slot, right? Like we
No,
literally had something else that we had put together we were going to talk about. And we're like, you know what we need to talk about?
this.
We need to get out in front of this. And for us, this is just an opportunity again to keep educating you all to make sure that you're taking back control and you have the guarantees in your life that you deserve.
Mhm.
And so as always, Jeremy, you're already in banking.
You're just not the banker yet.
So be blessed. We appreciate you guys being here. We'll see you in the next episode. Book that call with us if you're ready to take that next step to learn how you can have your own privatized family bank.
Take care.
Thanks for joining us on WealthWise Banking. If today's episode inspired you, please subscribe, leave a review, and give us a like. It's a simple way to help others discover these empowering strategies and join our community. Together, we're building a network of people who believe financial freedom is within everyone's reach. Remember, financial independence is about making every dollar work for you, one step at a time. Until next time, stay inspired, stay in control, and keep building your legacy the wise way.